So first Silicon Valley Bank and other regional banks, now Credit Suisse. What is going on and how is this affecting mortgage rates? Let's break it down. Hi guys, I'm Vince DiFilippo with Keller Williams Premier Properties from Westfield, New Jersey. Do me a favor, if you find value in the content, please hit the like button and subscribe. Okay, let's get to it. So we saw Silicon Valley Bank go under as there was a mass exodus of deposits that clients wanted back. The lack of cash in hand forced Silicon Valley Bank to sell some treasury bonds, which caused them to suffer massive losses. The Federal Reserve has since guaranteed all depositors money to help stem the outflows of deposits from other regional banks. Just as this was calming down, we got word this past week that Credit Suisse was experiencing massive outflows. The chief executive officer had launched a large outreach to attract back nervous clients and their cash over the last 6 months. The effort appeared to be paying off by this January when Credit Suisse reported net positive deposits. However, on March 9th, the U.S. Securities and Exchange Commission queried the bank's annual report, forcing it to delay its publication. Panic spread after regional U.S. lender Silicon Valley Bank failed and the contagion to other regional banks due to rapidly rising global interest rates that eroded the value of its U.S. Treasury bond holdings. Investors began ditching anything that smelled of banking risk and deposit flight. Things got further complicated when Saudi National Bank, Credit Suisse's biggest shareholder, refused to inject more financial assistance into Credit Suisse. This past week, Swiss National Bank offered Credit Suisse $54 billion in loans to shore up its balance sheet and stop the decline of its stock price and outflows. As a result of all this bank turmoil, investors, large and small, have piled into U.S. Treasury bonds as a flight for safety, and that has pushed down interest rates. Ironically, the two most important data points that the markets were so focused on, being consumer price index and producer price index, were really an afterthought compared to the banking crisis. However, this past week, the latest inflation data show that inflation is indeed declining, and that's what the Federal Reserve wants to see. As a result, mortgage rates continue to pull back from the 7% level of a week ago. Yesterday, this past Friday, we closed at 6.65 for the 30-year fixed mortgage rate. Lastly, the Fed is scheduled to meet this week coming, and as of this past Friday, there's a 62% probability the Federal Reserve raises rates by 25 basis points. Mind you, that prior to the banking crisis, the market was pricing in 50 basis point hike this week coming. Regardless, and most importantly, the markets believe this is the end of interest rate hikes. As we look out to the second half of the year, the market is pricing in interest rate cuts. So given the backdrop and a steady pace of declines in inflation, look for mortgage rates to continue to decline, which is great news if you're looking to buy a house. Thanks for watching, and again, if you like the content, hit the like button and subscribe, and I'll see you on the next video.